as we talk about what Chevron CEO Michael Wirth just addressed, this idea that maybe the risks are underappreciated, is this a situation where a risk premium can be built into oil markets, given what we saw in Saudi Arabia?
Well, good morning, Tom. And absolutely, there is a need for a risk premium now. If we look back at October of last year, oil prices went up to $86 a barrel just because the world was worried about Iranian sanctions and the lack of OPEC spare capacity. This has effectively taken out a lot of that spare capacity, potentially 3 million barrels a day of oil supply, which will take time to come back onto the market, and more importantly, has completely changed the geopolitical environment in the Middle East. This is a complete change on where we've seen before, where the Houthis were attacking infrastructure with intent to show their capability, but not necessarily to cause harm. This is a complete shift in the level of aggression that we've been seeing.
So it doesn't seem as though U.S. Energy Secretary Rick Perry has any real worries about this. He made some statements about the idea that the world seems pretty well supplied right now. Is there a case to be made that the move that we saw in crude oil, yes, reflects some of the risk premium, but that overall supplies in this world should push prices lower longer term?
I think there is a danger of complacency here. I think the fact that clearly the tension, as you heard from your reporter, is mounting between now the US and Iran with accusations, the locked and loaded comment, albeit that the US has stepped back a little bit and put the responsibility in Saudi Arabia to take the first step in responding to this. And the question is how they respond. So for me, it's the tension in the region between the biggest producers in the world that raises concern. You're absolutely right that in the short term, we shouldn't get carried away. There is plenty of supply in the market, albeit that the supply-demand balance is tight. It's going to get tighter into the end of the year. So the movement of prices yesterday into the high 60s was a measured response. But I think as the market starts to ingest some of the information from Saudi Arabia, start to understand how prolonged this impact might be on supply, maybe, as I say, 3 million barrels a day, then I think we may see oil prices start to move more perhaps into the 70s in the short term. There is spare capacity. There's storage available both in Saudi Arabia and outside of Saudi Arabia to cover some of the supply shortage. And the IEA also has stocks, strategic petroleum reserves, which the US has also made clear they are willing to release should prices start to escalate significantly.
All right. Let's talk about the demand side really quickly here, because Saudi Arabia is pretty dependent on the Asian markets. I mean, they do demand a good amount of oil from the Saudi region. Is there a scenario in which demand from places like China or elsewhere in emerging markets in Asia really starts to put some pressure downward on prices as well?
Well, first of all, indeed, Asia relies on a lot of supply from Saudi Arabia. 3/4 of the supply goes to Asia. So there's some concerns initially around supply. I think, therefore, if we do start to see prices start to move up, we will start to see that impacting demand. Our analysis shows that if we were to reach around $80 a barrel, which is not that far away, that would reduce demand growth in the world from around 1 million barrels a day in our forecast that we have right now down to 500,000 barrels a day. So indeed, you start to have the demand response. And this is why we're not necessarily calling for triple-digit oil prices, which some commentators are talking about. The real danger, and I think the worry that the US administration should be looking at, is that if we do move to those higher prices, we do start to push the global economy into recession. Gotcha. We've seen most recessions previously have been led by an escalation of oil prices or energy prices. And so we are in that dangerous condition where there's some significant headwinds that the global economy is facing, and high oil prices would therefore push it further. A move to $80 probably would reduce GDP growth by about 0.3%.